Recent global volatility has been a stark reminder of our financial system's fragility. Surging inflation, geopolitical shocks, and disrupted supply chains have placed immense stress on the very plumbing of traditional finance. These events expose deep-seated cracks, highlighting the urgent need for a more resilient infrastructure. This stress manifests in tangible ways, from sudden liquidity crunches to critical settlement delays that trap capital and increase risk. In our highly interconnected world, these are not isolated incidents. A vulnerability on one institution's balance sheet can trigger a dangerous domino effect, threatening the entire system. In response, blockchain technology presents a compelling alternative. Its core principles, immutability, transparency, and decentralization, offer a powerful toolkit to temper these shocks. Immutability makes records permanent and tamper-proof. Transparency provides a shared source of truth, while decentralization eliminates single points of failure, creating an inherently robust network. Now, blockchain is not a cure-all for market volatility. Instead, think of it as a sturdier set of rails for finance. It enhances verification with cryptographic certainty and revolutionizes auditability with a continuous, real-time audit trail. This allows for greater trust and efficiency in every transaction. Perhaps most importantly, it enables programmable controls through smart contracts, which automate agreements and reduce counterparty risk. So how does this all come together? We'll explore how a more resilient system works in practice through the powerful applications of tokenization, DAOs, and the crucial role of stablecoins. Tokenization slices real-world assets into liquid digital units, widening access and market depth. This unlocks illiquid capital like in real estate by creating fractional ownership. Bringing more participants to the market fosters more efficient price discovery and greater stability. With atomic delivery versus payment, settlement risk drops as transfers finalize on-chain. The exchange of asset for payment is a single, indivisible event. This guarantees finality and eliminates counterparty exposure, compressing multi-day settlement cycles down to mere seconds. Programmable markets can tighten spreads and reduce operational friction. Powered by smart contracts, they automate logic for trading and liquidity. This streamlines operations and removes manual overhead, creating more efficient and resilient market structures that adapt dynamically to changing conditions. DAOs bring transparent governance, rules encoded, proposals visible, votes auditable. This model shifts trust from intermediaries to verifiable code. Every decision is recorded on an immutable public ledger, creating unprecedented accountability where stakeholders can directly verify all activity. In stress, they can adjust parameters quickly while preserving process integrity. Through a formal on-chain vote, a DAO can modify key variables like collateral ratios. This enables rapid adaptive responses to market shocks, while the process remains transparent and entirely rule-based. Stablecoins aim to dampen currency swings within on-chain ecosystems. By pegging their value to assets like the US dollar, they provide a reliable unit of account. This stability is crucial for building dependable financial services like lending and payments on the blockchain. They settle 24/7, enabling faster treasury moves and hedging flows. This continuous operation allows firms to manage capital and risk around the clock, reacting instantly to global events. It eliminates dependencies on banking hours, unlocking gains in capital efficiency and operational agility. Quantum computing is advancing fast, threatening classical cryptography's assumptions. Private keys could be exposed, signatures forged, and some consensus paths disrupted. Data recorded today might be decrypted tomorrow. The clock is already ticking. So, are we truly prepared for a post-quantum financial world? Post-quantum cryptography spans lattice-based, hash-based, and code-based approaches. Protocols are testing quantum-resistant signatures and key exchanges today. Migration means rotating keys, upgrading addresses, and hardening hardware and custody. The challenge is global coordination, performance trade-offs, and careful timelines. Two powerful forces define this decade: blockchain stabilizing rails and quantum's disruptive edge. Blockchain offers a foundation for a more trustworthy financial ecosystem with its transparent, decentralized ledger. But the rise of quantum computing threatens to shatter the very cryptographic principles that make it secure. Navigating this paradox, harnessing one revolution while defending against the other, is the central challenge for the future of finance. Our goal is to architect a new financial infrastructure, a quantum-proof, decentralized system. By proactively integrating post-quantum cryptography, we neutralize the threat before it materializes. This new paradigm will do more than just survive. It will thrive by enhancing liquidity through efficient markets, deepening trust through transparency, and building unprecedented resilience against systemic risks and targeted attacks. This is a global conversation, and your perspective is crucial. Join us in the comments. Where are you watching from? And what specific challenges or applications do you believe we should tackle next? Subscribe for our deep dives as we explore these solutions and build the future of finance together.